In 2015, Martha Stewart's main brand name sold for just a fraction of its original worth. Many have attributed the devaluation to Stewart's widely reported legal troubles concerning insider trading. In 2004, she was sent to prison for 5 months for related charges. So what did Martha Stewart do wrong? What exactly is insider trading? Well, in 2001, Stewart allegedly obtained non-public knowledge that a particular stock investment was about to lose money, and she dumped the stock early. This kind of knowledge is also known as insider information. It is only available to high-level executives or major shareholders in a company known as corporate insiders. While corporate insiders are allowed to trade any stocks, they must register potentially conflicting trades with the Securities and Exchange Commission. It's illegal to use insider information to profit from potential stock changes. This disadvantages public stockholders and betrays investor trust, which is vital to the health of the stock market. However, just because insider trading is illegal doesn't mean people don't still do it. There are usually huge amounts of money on the line, and the risk of getting caught is often very low. A study cited by the New York Times in 2014 claims that a quarter of all public company deals involve some kind of insider knowledge. The SEC has limited resources, so they only pursue the largest and the most legally viable cases. They can also be slow to respond to reports of illegal activity, taking more than 2 years on average to announce litigation. Additionally, many criminal charges aren't legally viable because the divide between intentional insider trading and pure coincidence is often murky. Many traders simply claim they got lucky to have sold off their stock before it devalued. This gray area is one of the reasons that Martha Stewart was never actually convicted of insider trading itself. She went to prison because she was caught lying to federal investigators about her role in the scandal. The SEC does its best to monitor suspicious trades. They act on tips or complaints, and they have market surveillance tools that track when large purchases or sales of stock happen. If they do make a conviction, any insider tip givers or tip receivers can get 25 years in prison. Individuals may also be fined up to $5 million, and companies may be fined up to $25 million. The largest aggregate fine for insider trading in history happened in 2014, where multiple guilty parties working with a hedge fund group faced penalties totaling $1.8 billion. Insider trading is one of the most common white-collar crimes, perhaps because it often seems to be victimless. But a prominent U.S. attorney involved in many Wall Street executive prosecutions says nothing could be further from the truth. The market is a victim. And the loss of trust in the public stock market will hurt the entire country's economy. Ever wondered what it would take to crash the stock market? We've got a video on some of the worst market crashes in history.
A crash represents a steep, sudden decline in the value of market prices, and it can often lead to an economic depression.
Thanks to everyone for watching TestTube News. Please subscribe to get new videos every day of the week.